So you've just won or settled a legal case. It's a huge relief, right? But then, months down the line, a letter from the IRS shows up, and it's got a pretty hefty tax bill you were not expecting. This happens all the time, and it can be a costly shock. In this explainer, we're going to break down exactly why this happens and, more importantly, what you can do about it.
In this number, this is what it's all about: 15.3%. That is the full tax rate for the Self-Employment Contributions Act, or SECA as it's known. It's basically the combined Social Security and Medicare taxes, and it's the number that creates what we call the self-employment surprise.
For a lot of people, this isn't just some small accounting error, it can be a really significant financial blow. So how does a big win in court suddenly turn into a massive tax headache? Well, let's get into it.
Here's our game plan for today. We're going to tackle this step by step. First, we'll look at the surprise bill itself. Then, we'll decode the specific IRS forms that kick this whole thing off. After that, we'll dive into the core legal ideas, the key defense you can use, the actual procedural moves to fight back, and finally, we'll wrap up with the big strategic takeaways for everyone.
All right, let's start at the beginning. That moment, the problem becomes very, very real, when that dreaded IRS notice lands in your mailbox. So what exactly is this self-employment surprise? Well, it's what happens when the IRS's automated computer systems flag your settlement income. The system sees a payment reported in a certain way, it just assumes it must be self-employment income, and then it automatically spits out a CP2000 notice proposing to tack on that 15.3% SECA tax that you never planned for.
Okay, so why does the IRS system get triggered in the first place? It all comes down to one thing: the specific form that the person or company who paid you the settlement used. This is really the source code of the entire problem.
Now this right here, this is the critical distinction. Look at these two columns. On one side, you have Form 1099 NEC. This form sends a really strong signal to the IRS that says, hey, this was a payment for services. The computer's algorithm expects to see that income on a Schedule C. That's the form for business profit and loss, and that automatically triggers the 15.3% tax. On the other hand, a Form 1099 MISC with the money in Box 3 sends a totally different signal. This is other income. That flows to a completely different part of the tax return, and usually, it's not subject to SECA tax. So you can see how the payer's choice of form basically decides the tax fight you're about to have.
Now, there's another little detail we need to talk about, and it has to do with payments to attorneys. Payers are required by Internal Revenue Code Section 6045F to report the total gross proceeds on a 1099 MISC in Box 10. This is mostly just for the IRS's information. But the crucial part for you, the plaintiff, comes from a big Supreme Court case, Commissioner v. Banks. It means you are taxed on the entire gross settlement, and that includes the part that goes straight to your attorney's fees. You'll get your own separate 1099 for the portion that's taxable to you.
So if the form is the trigger, what decides which form is the right one to use in the first place? Well, that brings us to the most fundamental legal rule for figuring out the tax nature of any settlement.
It all boils down to this one simple question. The Supreme Court, in a case called Gilmore, gave us what's known as the origin of the claim doctrine. And what that means is the tax treatment doesn't depend on what you call the payment. It depends on what that payment is replacing. Was it replacing lost wages? Lost business profits? The answer to that question changes everything. So, this leads us to the two most common situations. If a settlement is replacing lost wages from, say, an employment lawsuit, it really should be reported on a Form W-2. In that case, the employee pays their half of FICA, that's 7.65%, and the employer pays their half. But if it's replacing lost profits from a business dispute, it usually gets put on a 1099 NEC. And that pushes the entire 15.3% SECA tax burden right onto the person who received the money.
And this is where things can go really, really wrong. The crucial point here is that ambiguity is your absolute worst enemy. If a settlement agreement is just a vague lump sum payment with no details about what the money is for, the IRS will almost always pick the interpretation that results in the most tax. And that means treating the whole thing as lost profits, subject to self-employment tax, leaving you with the biggest possible bill.
But here's the thing. Even if a payment is for lost profits and it's reported on a 1099 NEC, that doesn't automatically mean it's subject to self-employment tax. And this brings us to a really powerful defense, all thanks to a key case from the tax court.
The case is called Newberry v. Commissioner. The facts are super simple. A grocer's store burns down.
While it's shut down for rebuilding, his insurance company pays him for the profits he would have made. The IRS shows up and says, "Aha, that's self-employment income."
But the tax court said, hold on a second. The IRS argued that because the payments were a substitute for what would have been self-employment income, they should be taxed that way. But the court looked at the actual words in the law and made a crucial ruling. For self-employment tax to apply, there has to be a direct connection, a nexus, to a trade or business that is actually being carried on. Since Mr. Newberry's store was physically closed, he wasn't carrying on the business. That nexus was broken. No self-employment tax was due. This is the carried-on defense, and it's a huge deal.
Okay, so we have the legal theory down. That's great. But how do you actually put it into practice? What do you do when that IRS notice is sitting on your kitchen table?
When you write back to the IRS about that CP2000 notice, you need a clear, structured argument. First, you state the facts, and you should use the exact language from the court cases. Argue that the payment lacks a nexus to a business being carried on. Second, and this is critical, you have to cite the legal precedent, specifically Newberry and a related case called Milligan. And finally, you have to provide the evidence, like the original lawsuit complaint and the final settlement agreement, to prove what the payment was really for.
Now there's a particularly painful version of this problem that I call the double tax trap. This is what happens when a settlement is clearly for lost wages, but the former employer screws up and reports it on a 1099 NEC instead of a W-2. The result? The former employee gets slammed with the full 15.3% SECA tax. In effect, they're being forced to pay not just their own share of Social Security and Medicare, but the employer's 7.65% share too.
Thankfully, the IRS created a specific tool to fix this exact situation. It's Form 8919, Uncollected Social Security and Medicare Tax on Wages. This form is the direct procedural fix for that double tax trap.
So here's how it works. You use Form 8919 when you were paid as a contractor, but you should have been an employee. You check the box for Reason Code H, which is designed for exactly this scenario. The form then automatically calculates the correct 7.65% employee-only share of FICA tax. And here's the best part. The income then gets reported on the wages line of your main Form 1040, not on Schedule C. This completely sidesteps the entire self-employment tax calculation. It's a lifesaver.
Okay, let's pull all of this together. What are the key strategies that both sides of a settlement can use to avoid these tax nightmares from the very beginning?
For the company paying the settlement and their lawyers, it's all about being proactive. First, be incredibly precise when drafting the settlement agreement. Spell out exactly what the funds are for. Second, avoid vague lump sum payments like the plague. They're just asking for the IRS to reclassify them in the worst way. And third, really think about which form to use. Don't just default to a 1099 NEC. If the damages weren't for services, Form 1099 MISC Box 3 is probably the right call.
And for taxpayers and your advisors, your playbook is about being both corrective and defensive. If you do get an incorrect 1099 NEC, there's a common approach called the in and out strategy. You report the income on Schedule C just to keep the IRS computers happy, but then you immediately expense it back out with a clear explanation and report it correctly elsewhere. Always, always assert the Newberry Defense when your business was suspended. And for misclassified wages, remember, Form 8919 is your silver bullet.
So, at the end of the day, it really all comes down to this one question. With careful planning and a solid understanding of these rules, a settlement agreement can be structured as a tax asset that maximizes what you take home. But without that foresight, it can easily turn into an unforeseen and very, very expensive liability.